Our recent AM Best webinar looked at the state of the Caribbean insurance market. We began by looking at how 2018 compared with previous years.
On a consolidated basis, 2018 was a good rebound year after storm losses in 2016 and 2017. I guess we'll talk about rates and pricing a little bit later, but compared to 2017, the table on the screen, which I'm guessing that it probably won't be visible clearly for a lot of viewers, but if you look at that table, it's in our report. Gross premiums increased by almost 10% to 1.3 billion from 1.2 billion. Net premiums increased by almost 19% to 530 million from 446 million. And we saw net income increase by more than 800%, or almost $36 million. Just to put that in perspective, though, in 2016, consolidated net income for the region was 45 million, and in 2015 it was 65 million. So while it was a rebound from 2017, it still was a little bit below the levels of income before the storm years in 2016 and 2017. The combined ratio decreased 10.4 points to 96.2% from 106.6%. Now, most insurers would generally have been pleased with the 2018 results, apart from the insurers, I would guess, that would be domiciled in Barbados and any of those insurers that had exposures to Barbados sovereign debt. It wasn't such a good year for those insurers given the investment losses that they had to incur as a result of that country's debt restructure, which negatively impacted their net income and as a consequent surplus. So we saw surplus decrease, consolidated surplus decrease by 1.4% in the region. Rich?
Thanks, Ricky. So there are 8 rated life companies in the region, and the performance was a mixed bag, but it was favorable overall. There was a continuation of the growth story, but at a lower pace than we saw last year. Total revenues for the life group were up about 5% in 2018, with most companies showing modest growth in both premiums and net investment income. The premium growth correlates with the year-over-year improvement in the economies as the region's recovering from the storms that Ricky mentioned. Tourism is increasing, and the spending on infrastructure all tends to be spurring the economy. The increases in net investment income are mainly a function of growing asset balances. We're seeing continuation of asset growth, and it's not a function of the yield, it's more on the asset balances side. Net investment income was also mixed, but overall it increased 13% in the aggregate over 2017. Nearly all the companies had positive earnings, but half of the life companies saw growth in net earnings, while the other half saw a little bit of a pullback on the earnings growth. The earnings were impacted by higher policyholder claims that we saw, particularly on the accident health side. But there was also some benefit in the realized gains category, where some companies were rebalancing some of their portfolios, and that benefited the overall net income picture for the group.
Are you beginning to see microinsurance in the region?
There's been a conversation that's sort of been developing in the last few years in particular. I'm not aware of a broad-based approach to any one solution, but I am aware that there are some conversations that are going on. And I think, if you're a government in a country that has a significant exposure to catastrophe losses, it is definitely something that you'd want to have a conversation about, because to the extent that people don't buy insurance in the private sector, it's going to largely fall on the governments of those respective countries to sort of provide some kind of solution for people that can't afford to buy insurance, that have significant loss and damage and need some assistance in sort of getting back on track with their normal lives. So there's definitely a motivation for governments to look at this and to take it seriously and to assist in providing some solution.
All right, Dean, are we seeing new entrants into the market?
Not many new entrants, but to elaborate on the point Patrick made with respect to economics, and rates, I'd also say it depends on where the rates were before the significant loss occurred, so that in territories where the rates were closer to the risk in that particular territory, so let's give an example of BVI, for example. BVI prior to Hurricane Irma and Maria had their rates increased by in excess of 70%, as compared to their neighbors. The USDI only had rate increases that were around 10% or less. And the reason for that was prior to the hurricane event, the rate in BVI did not reflect the risk for the territory, so that they had a more significant risk adjustment, to that particular rate. Similarly, in most of the Eastern Caribbean territories, there were rate adjustments, certainly for us, that was somewhere around 20%, between 15 and 20%. So they did not have a significant increase. And that is where Patrick's point of economics, came into play. It's so whereas in those particular territories, it would be very difficult, after a significant event like a hurricane, to have an adjustment that would be, let's say, 20% of the rates that they faced before.
You can view this webinar in its entirety by logging on to ambest.com. For AM Best TV, I'm John Weber.